KK Mistry, Vice Chairman and Chief Executive Officer of HDFC, India's largest mortgage company, joins us now. KK, morning. Thank you for joining us. Are you happy with a 50 basis repo rate cut? Do you think the good news here is that the repo rate cut has come, but the bad news here is that CRR was not changed?
Very clearly, the CRR cut was not on the cards. We had a lot of liquidity shortage in the system in the January to March period, and banks were borrowing something like 1,30,000 to 1,50,000 crores every single day. But if you look at this number post-April, the quantum of bank borrowings from RBI has come down. Liquidity has re-entered the system to some extent, and the borrowings from the RBI is about 70 to 80,000 crores. So with liquidity improving compared to the levels that prevailed in March, and especially given the fact that RBI itself has a comfort level up to 60,000 crores, it was unlikely that CRR would be cut. So that, I think, straightaway was ruled out. Now, a couple of weeks ago, whether there would be a repo rate hike, and if a repo rate hike if at all it was there, would it be more than 25 basis points, looked very, very doubtful. But what has happened in the last 2 weeks is we had the IIP data. The IIP data came out significantly weaker than what people expected, and what was more important was that the earlier month's figure was reduced. So a combination of that resulted in RBI's decision to cut the repo rate, because basically it is a signal to the market that rates have to come down and that growth is very, very important.
KK, hi, morning. So would this warrant a cut in deposit and lending rates for HDFC in particular, and how would the margins of HDFC look like over FY13?
I can't talk about margins. We are close to our financial results, but having said that, we've always targeted margins or spreads which are in the range of 2.25 to 2.3, and we are comfortably in that position at the moment. As far as the lending rates are concerned or deposit rates are concerned, our borrowing comes from a whole host of sources. So unless the cost of funding reduces, we don't change the lending rate. But whenever cost of funding reduces, we always immediately react and change the lending rates. For example, when RBI increased interest rates quite frequently a few months ago, we did not keep increasing our lending rates. So our lending rates changed a couple of times during the course of that period, but not as often as RBI changed rates. So if our cost of funding reduces, of course we will reduce the lending rate.
KK, Reserve Bank of India has clearly mentioned that no further rate cut is on the anvil. So is there a possibility of a repo rate cut in the second half of FY13?
It's too early to talk about the rest of the year, because it's so data dependent. It's depending so much on what is happening in the Western world, what's happening on oil, what's happening in our own country in terms of IIP numbers, in terms of GDP numbers, in terms of inflation numbers. But having said that, one could have expected about a 75 to 100 basis points reduction in interest rates during the course of the year. And of that 75, if you assume that number continues to remain 75 to 100, 50 basis points out of that has already got covered.
Would the demand for housing loans significantly improve after this rate cut? What's your outlook on the credit growth as well as disbursement for HDFC and the housing finance sector as such?
See, we have always said over the years that we don't think that interest rates is a significant influencer in a person's decision on whether to take a loan or not. Because when you're buying a house because you need a house to stay in. It's not an investment, it's not a speculative activity, and therefore if you like the house, the family likes the house, it's affordable, you're confident about your job, you're not going to not buy the house just because interest rates are 0.5% higher or 0.5% lower. And therefore, as we've been saying right through the last 1 year, we don't think there will be any significant impact in the demand for housing loans in a period when rates were high, excepting maybe in cities like Mumbai where property prices are very high. So therefore, a reduction in interest rates will improve sentiment significantly. It may help demand in a city like Mumbai, but on a pan-India basis, we never saw a decline.
The Reserve Bank of India is also expected to issue draft guidelines on the regulatory framework for NBFCs. What are your expectations in terms of guidelines?
That is for NBFCs. If you're talking of housing finance companies, we are regulated by the National Housing Bank. For example, this the requirement in today's policy that banks would not be levying a prepayment charge on floating rate loans, that has been applicable to us right from October. So Our regulations are framed by the National Housing Bank, and usually whatever is there for banks is adopted for us. So for example, our recognition of NPLs is on a 90-day basis, unlike NBFCs, which is on a 180-day basis. Risk weights on loans are on parity with the way they appear for banks. So it's broadly in line with what the banks do.
KK, banking bill, PFRDA, as well as insurance bill are all expected to be tabled in the Parliament in this session. What is your expectation on these bills? Do you think they would go through this time?
One has to wait and see what these bills are actually going to say and how these bills are. But you know, if what the market is looking for is some kind of a policy which says that foreign direct investment, for example, in insurance, is increased from 26 to 49%. But given the way things are at this moment, kind of political situation that exists, it's very unlikely, at least in my opinion, that you would see a relaxation in the FDI limit on insurance right away. It's something which will happen, but probably not straight away.
KK, let me hear from the horse's mouth. How do you view real estate prices could move for this fiscal, which is FY13?
See, you have to look at prices differently for Bombay, and you have to look at prices differently for the rest of the country. Our analysis would show that the cost of a house as a multiple of the annual income of our borrowers is today in the range of around 4.8 times. Meaning a house costs roughly 4.8 times the annual income of a typical customer of ours. And if you take the last 10 years, this ratio has been between 4.5 to 5.5. So it's pretty much within the margin that has existed over the last 1 year. Now, obviously, if you look at Mumbai, house prices will not be 4.5 times the income of our borrowers. It will probably be much higher. So Mumbai property prices are very high, but the primary reason why property prices are high is just because of shortage of supply. The demand for housing is always going to remain. And if the only way property prices in a place like Mumbai can come down is if supply is to increase and increase at a very rapid pace. For supply to increase, infrastructure, a much better infrastructure has to be in place. If infrastructure is created, if you have better schools, colleges, better roads, transport, water, sewage and all of that, then you can permit buildings to go higher and create more supply. And that will automatically bring prices lower. Demand for housing is always going to be there. You got to remember that for people buying a house, it's a basic necessity. It's not an investment and it's not a speculative activity.